Most people think markets move based on earnings, news, or economic data, but those are just narratives layered on top. The real driver underneath is liquidity. Liquidity is simply the amount of money available in the system. When there's more money, it has to go somewhere. And most of the time, it flows into financial assets. When liquidity is high, borrowing is easy, capital is abundant, and investors are willing to take risk. That's when stocks rise, valuations expand, and everything feels like it's working. When liquidity tightens, the opposite happens. Money becomes more expensive, risk gets pulled back, and assets start to fall. Not because something suddenly broke, but because the fuel behind the system is being removed. This is why markets can rise even when the economy looks weak, and fall even when the news still sounds positive. Because liquidity doesn't move with headlines. It moves underneath them. Central banks play a major role in this. When they inject liquidity through policies like rate cuts or quantitative easing, they're not directly pushing markets higher. They're increasing the amount of capital in the system, and that capital has to find a home. And when that flow reverses, the impact is just as powerful. Liquidity leaving the system forces assets to reprice, often faster than people expect. Markets don't run on logic. They run on flows, and liquidity is the foundation of those flows. Most people focus on what is happening. Capital theory focuses on what is flowing. If you want to understand how money really moves, follow.